I said, didn't you ever think that maybe you just weren't cut out for this? After failure, after failure, after failure. And he just said, no, I just knew I just felt that I could do it. And so part of the lesson, one lesson is that early failure doesn't mean necessarily long-term failure. And the other lesson, I guess, is to be a market wizard, you have to have perseverance.
Welcome to the AlphaMind podcast with me, Stephen Goldstein, and my co-host, Mark Randall. Today, joining us on the podcast is author of the Market Wizards series of books and the new book, Unknown Market Wizards, Jack Schwager. Before we start this week's episode, a quick word about our podcast partner, the Society of Technical Analysts, the STA. The STA are the world's oldest body serving the trading community for the advancement of technical analysis and price action knowledge and education. They are a not-for-profit community open to members from around the world. The STA offer outstanding publications, talks, webinars and conferences and have partnered with some of the world's leading academic bodies to provide top-quality training and education courses, programs and diplomas. As part of our partnership with the STA, listeners of the AlphaMind podcast can get a £100 or local currency equivalent discount on the cost of their superb home study course and diploma program. To find out more about this, visit the home study page at the top of the AlphaMind blog. You can find that at alphamindblog.blogspot.com or just Google AlphaMind blog. Also, a quick word about some of the coaching and developmental services we offer to people in the trading and investment world. The AlphaMind Trader Performance Coaching Program has been delivered to leading traders and investment professionals across the financial markets over the past 10 years and helps them to develop their risk capability and their risk processes and improves how they manage with the psychological and emotional aspects of engaging with financial market risk. As well as working with retail clients, our clients include global hedge funds, asset management firms, investment banks, energy and commodity trading businesses. We also offer a suite of other services, including AlphaMind Mental Strength Development Coaching, which is based on programs we have delivered to senior executives at some of the world's largest corporations, as well as to traders and investment specialists. We also offer high-quality executive and performance coaching programs to leaders and managers from across the financial markets and beyond. To find out more about our work, visit our partner site, alpharcubed.com. That's the word alpha, the letter R, and the word cubed.com, or email info@alpharcubed.com. Now on with the podcast.
Welcome to this week's AlphaMind podcast, and we're delighted to have Jack Schwager with us. Yep. Jack Schwager, Market Wizards fame. Jack is back. Jack is back with a new book called Unknown Market Wizards, which continues in the 3-decade tradition of the hugely popular Market Wizards series, interviewing exceptionally successful traders to learn how they achieved their extraordinary performance results. The twist is, in Unknown Market Wizards, is that featured traders are individuals trading their own accounts. They are unknown to the investment world. Until now, of course. These traders have achieved performance records that rival, if not surpass, the best performance managers. Jack, tell us more. Tell us more, perhaps to start with, about Jack Schwager.
Thumbnail sketch, academically graduate degree in economics. Started out as an analyst in the futures markets. Spent about 22 years as a research director in futures. 10 years with a hedge fund advisory firm in London, although I was a token American and I was not in London. I would just travel every quarter. Co-founded the Fundseeder, which is a technology company providing a platform for traders to analyze their results and use various tools. Basically a free site so we can discover trading talent, some of which are in this book. And over the course of all of that, I've written, 11 books, and 5 of them being on the Market Wizard theme. So that's the shortest version I can make for a long career.
Terrific, and welcome to the podcast, Jack, and a pleasure to have you. I've met you before, but I'm so excited about having you on. First of all, because I've read all your books, and I still have my first copy here.
Yeah, that's
from about 1989 when it first came out, when I was a young trader trying to make my way in the London markets. And I've still got the yellow post-it notes, and no one can, you can see there, and lots of marks in there. You've got to say it's a credit to the 3M post-it notes company that they're still in there. And of course, I'm so excited about this new one because I've actually got I've got 3 clients that I've coached over the years featured in the book. So it adds a special element to it. But I'm really curious as what drove you to start writing the Market Wizards book?
So originally, my first book, and most people think my first book was Market Wizards. It was not. About 5 years before that came out, I took a sabbatical, and I wrote a book called The Complete Guide to the Futures Markets, which was, my answer to the observation that I didn't think there was a decent book on analysis of futures markets out there, so I might as well write my own, because when I started out, I was looking for something. I didn't think any of them were any good. So I took sabbatical to write that book, and for what it was, which was a big analytical book, it was successful and was good, but it wasn't a popular, it wasn't a popular audience book. It was, so anyway, I had the idea, because I got involved in research in the futures. It's a short step to then want to trade yourself. And I had the idea that, probably a neat idea to go across the country and interview the best traders and kind of ask them how they do it, and sort of, I could become a better trader myself by doing this project. Plus, it just seemed like a fun project. But I was working as a full-time research director, and that's more than a typical 9-to-5 job by itself. So it just was an idea I had. I think I even had the title, but it just sat there for several years. And then I got invited to lunch with another publisher, and they pitched me this idea. Hey, we really like this analytical book you did. We think you'd be great to be an editor-in-chief of this whole series. One book on each market, analyzing each market. I said, look, I've done that. I don't want to do it again. I'm going to do anything, else. This is exactly the opposite direction I want. They were talking about high-priced books, for small audience, right? For each of those books, and I said I want to go the other way. I want to write something, more mainstream, wider audience. And I told them, look, I have this idea, and I told it to them, and they said, great, do it. So that was the catalyst. Otherwise, who knows if I ever would have gotten around to it.
Were you surprised with the success of the first one?
I thought it was good. I thought I had an objective. I had an objective of writing a book that would have lasting appeal or be meaningful. Because I do remember. I don't remember if I put it in the preface of the original Market Wizards book. I have to go back and check. But I did have. I know I felt at the time that I had read a book called Reminiscence of a Stock Operator, written back in the 1920s. And I thought, gee, surprised. And this is a book that's kind of talking in the era of Jesse Livermore. Supposedly the protagonist is Jesse Livermore. It's back in the time of bucket shop, so it's a bit ancient in that respect. But there are many quotes in that book where the protagonist is speaking about trading, and it just rang so true. And this, I was reading it 65, 70 years later. So my goal really was to write a book, not oriented just to the present moment, but something that tried to capture truths about trading that hopefully would be as pertinent, 65 or 70 years later. So the fact that that was my objective, I don't know if I was surprised that it met that, but but I was shooting for a long-term meaning to the book. This is the 5th in the standard format, and I did one called The Little Book of Market Wizards. After the previous traditional format Market Wizards book, and that was like a summary of, a narrative summary of some of the key things I learned doing the other books.
Yeah, I just love the style of them. I mean, I just love the fact you just go through the trades. You just reflect directly at just the process. And so the narrative feels as though we're listening to, the likes originally of the original book, Richard Dennis and Paul Tudor-jones and Ed Seykota, all those types of people, you were bringing them to life. And then, of course, after the dialogue, you then went and did sort of a conclusive several pages of just bring in, from your point of view, some of the qualities that were really, really important. And I think what strikes me about your current book, actually, there's huge overlap. If you look at the successful people, you could almost take the quotes and mix them up across the whole series, and they could be from all of them. Even the people that we consider to be unknown, they've kind of like nailed the process that you could lift up and say, well, actually, you could ascribe that quote to one of what we could consider the greats. But it was just this guy that's come up through his own process. So, yeah, I think it's super readable, and I'd encourage everyone that's not read your books, particularly if they're new to the market, as well as picking up Edwards and McGee and those types of books, get your stuff in portfolio, because you'll learn so much wisdom.
Oh, thank you.
One of my questions, one of my thoughts, first of all, was, how fresh this book feels. I was amazed by that. I just got this, it's almost like, I suppose there must have been a danger you felt of just repeating everything.
Yeah, well, look, many truths about trading they're truths because, they don't change over time. I mean, so it's not surprising that a lot of the traits that I pick up from the original market was just over 30 years ago are shared in some way by the traders I interviewed in this book. So that part of it is not surprising. I do have a goal. I'm not only trying to communicate important lessons about trading, but an equally important goal for me, and I'm writing these books, I want to please myself as well, is I want them to be interesting. So I want to, I'll throw away interviews where, even if there's something useful trading wise, but if it's really deadly dull, I mean, there's just nothing of life in the interview that I can make interesting to me, then I won't use it, because I personally actually don't like interview articles. Typically, I will usually not read interview articles. It's not but the idea, what I'm trying to do is I'm using that format, but I'm trying to create narratives, from the traders. So it's not so much the interview as it is getting them to open up about everything, their life, their failures, everything. So it is important, because I think it has much more staying power if the person seems like a real person than if it's just you're reading, like a cookbook thing of do this, do that, So that is part of the thing I'm trying to do.
Yeah, well, I mean, you certainly achieved that, and and the interviews were so different as well. Chris Camillo, I mean, I just thought that was a brilliant interview, and that was something that it could never have been done that way in the first book.
No, I mean, it didn't exist. So
yeah.
So just for context here, Chris Camillo. Well, before doing this book, I had the impression, not the impression, kind of. I'll use an analogy here. You throw a coin up in the air, you expect it's going to be heads, it's going to be tails. It never enters into your mind that landing sideways is a possible outcome, or is in the universe of anything to consider. So the analogy to trading is, I always basically just, all this fundamental types of approaches, and there are technical types of approaches. They can be very different. Technical could be charts, it could be systems, it could be, but those are the two general spheres. And what else? There is nothing else. How else? How else? Anything you trade, I naturally assume, got to be one of those. Got to fall in one of those two spheres. Well, it turns out with Chris Camillo, it falls into neither, and neither is actually the chapter title. And probably the audience, is going to wonder, what the hell? Well, what the hell could he be doing? It's not. And to be clear, he doesn't use fundamentals at all. No fundamentals at any time. He doesn't care about earnings reports, any of this stuff. He doesn't use tech charts. He doesn't even know where the price is relative to the broad range. Doesn't enter whether the price is at highs or at lows, or it has nothing to do with his approach. So how the hell does he do it? Well, the thing is, he latched on to social media as a way of identifying trades. So he used to do it manually originally, but eventually he built a company that developed the software for himself so he could make it more efficient. But essentially, what he's doing, he's picking up on social media spikes in conversation to identify potential trends. And as he says, he's not trying to predict anything. He's just trying to identify what's happening now quicker than anybody else. So, for example, I mean, lots of examples in the book, but let's throw out just one example. When we were going some number of years ago, where we'd gone through a transition from people getting turned off to sugared sodas to starting to drink sparkling waters of different types. So he kind of picked up on that very early, and there's a company called National Beverage Company, which was a manufacturer of LaCroix. And he saw this spike of conversation about people talking about this product, and that turned him on to this trade in its infancy. So and certainly well before earnings reports, but even before it would show up in credit card transactions, because some sophisticated hedge fund managers sort of get the credit card data so they can identify pre-earnings, have some shot at it. But he proceeded that. So by using social media, he was able to identify these trades at their infancy, and he's done enormously well.
Yeah, I mean, I got a sense of, and I made a note of this, and I thought this was very profound. He said, I'm not trying to predict the future. I'm trying to accurately and quickly depict the present. I'm not trying to predict what people will do, but rather identify what they are doing right now, what they are interested in right now, what they are buying right now. And I actually thought this was a bit like the Keynesian beauty contest, where kids used to say, it's not the prettiest face that matters. It's what you think other people think is the prettiest face.
Yeah, well, that thought applies more to another interview in the book by Jeff Newman, where he identifies these trends very early, completely differently. I mean, just by aware things. But there, his approach is to identify these things very early, gets in really early, just an initial breakout, something like 3D printing. And a lot of as I was going through the interview, it struck me that a lot of these trades he was talking about, these major sector trades, sectors, he defines his own sector, like 3D printing was one of his for him. So, he ends up riding it, and most of the trades he mentioned in that in that interview, ultimately they went all the way back down. Except, of course, he used the same, awareness of when the thing was sort of getting too popularized and overextended, and typically got out on the distribution top or when it started to break down. So he had these incredibly 10-to-1 type trades by identifying things, even though the particular item he identified or sector he identified went all the way back to where it started. So that's your perfect analogy to the Keynes beauty contest. It's not picking the prettiest girl, but who you think everybody else is going to pick as the prettiest. So that's the perfect analogy, in regards to him. And going back to Camillo, he actually in the beginning he wasn't just preceding the social media. There's a Peter Lynch element to this. So Peter Lynch, sort of, when he wrote his book, he kind of made a point that trade what you know, invest in what you know, be observant, and sort of when I listened to some of the things that his trade. So Chris lives in Texas, which is kind of representative in a way of the U.S. It's kind of has a bits of everything in it, and talked about seeing these people standing online to go to Cheesecake Factory or P.F. Chang, Chinese restaurant. And all of us who have had real Chinese food know it's not really Chinese food. But as far as sort of rural America goes, or regional, or that typical America goes, this was like a new thing. And so seeing people standing online for chain restaurants, that was a tip off to him that this was a trade. And there's lots of other examples. So part of it is that Peter Lynch element, And then by the social media made them more effective. It became what he could pick up from any, just through social media, which wasn't just confined to his geographic space.
That was quite interesting, actually. That bit about social arbitrage was the term he used.
Yeah, it's his term, social arbitrage.
But he also said that there was this thing about focusing on stuff off the radar where the typical Wall Street types wouldn't pick up.
Yeah.
Because it doesn't get to it.
He'll go out for dinner at P.F. Chang, I can tell you.
Was that a surprise finding him?
Yeah. What's the big surprise was his approach. This was something that never entered my mind as part of the trading universe. And of course, his results were extraordinary. And it was a surprise to find him. And here to give credit for listeners here, Steve actually can take credit for having more influence on this book probably than anybody else by being the source for two of the traders in the book. And so, thank you for that, because they were certainly incredible traders, or are incredible traders. I think it was two. I think it was Amrit and Dalgid. I think you were the source for both of those, I believe.
Right. Okay. So if I haven't sent you the bill yet, have I?
You haven't.
No.
Yeah, I'd love that Chris Camillo piece. I guess, it's an indicator of where this world is going. We talk also about the gamification of the business, and there are different types of people are coming in that are observing things very differently to what we had traditionally observed. However, I would talk about Jason Shapiro at this point, because actually, his observation of the Commitment of Traders report, I thought was very, very interesting as well. Obviously, readily available, CFTC released information that is there, and yet was watching that to be able to build up a contrary view of trade opportunity. So I was very fascinated by that, because I think in your previous books, I don't think anyone else had been revealed, as it were, as having that type of strategy.
There was one trader in hedge fund market wizards, a fellow by the name of Jimmy Baladimus, who, well, for context, we're talking here about Shapiro. He's a contrarian. He really just wants to fight he wants to fight what he feels excessive sentiment on one side of the market. And Baladimus kind of shared that, although in a totally different approach. So he's not the first contrarian, but his approach is certainly the only one of its type that in any of the market wizard books.
Yeah, and a non-professional as such, right? It's very interesting to see what these guys are picking up upon.
Yeah, although in his career he did work for hedge funds managing money within hedge funds, as much as $600 million at one point, but became just didn't like it. He hated marketing. He didn't want to be talking to investors. He just wanted to in fact, now he basically said he's a solo trader, and he just won't do it. He said he doesn't care how much money is offered him to manage. If it requires hiring even one person, he won't take it. He just doesn't want to. He doesn't want to do that.
Yeah, interesting that he was essentially focused upon the emotional flaw of others, I think was the quote.
The emotional flaw of others, but as he points out, and he's talking about, just giving a little background here, because you read the chapter, but obviously listeners haven't. So in his early career, he went through like some of the original market wizards. He blew up his account twice. In other words, he went from 100,000 to say roughly $1 million, and each time totally blew it. Because he hadn't learned risk management, and he was just he still had this contrarian. He's the type of guy who'll argue it. He'll go to a cocktail party, and if it's mostly Republicans, he'll take a liberal side, and if it's mostly Democrats, he'll take a conservative. He just wants to argue with everybody, So he's got that type of personality and attitude. So it's not. He was always had this contrarian streak in him, except being a contrarian without money management is like I don't know, being a race car driver without a brake. I don't know. It's not a survivable situation. So he learned that, and then he recognized his flaws and became very successful. He would see it in other people. So, as one point, I'm going to paraphrase here. So he says this person that he worked with at one point was a great contrarian indicator, because whenever he had an opinion, it was usually wrong. And so if he was bullish, that was a sign he should be bearish. He mentioned one point where, in fact, this past March, where we had the collapse during COVID, there was a call, and this person was on it. And this person, he said, is usually bullish, saying, well, we haven't seen market capitulation. Well, that night was the exact bottom of the market. And even though he didn't have a signal yet, he put on some position long, just because this person said it. And he said, it's not that, he was very clear, it's not that, I'm better than him. It's, he is who I was. I see myself in him. He's making the same mistakes I made back in the 90s. So it's that recognition. So it's not just seeing the flaws in others, the way Jason puts it, it's seeing the flaws in others, which are his flaws when he was a losing trader.
So he recognized himself.
Yes.
Yes. And ironically enough, in brackets on my notes for Jason Shapiro, I wrote that he's a contrarian who is possibly a counter-contrarian. Yeah. He sees the contrarians, and then, he recognizes himself,
yeah,
and that gives him the signal.
Yeah, it's just seeing the flaws of not so much. He sees the flaws of people who are caught up in the markets, euphoria, without a plan of how to manage the risk.
You mentioned about the blowing up there. I mean, that stood out for me in the first book, and it stood out for me in every single book ever since. And it seemed, it stood out for me in this book again, because almost everyone, not everyone, but almost everyone had early blow-ups. Some had multiple blow-ups. If they didn't have blow-ups, they had sharp and deep corrections, wake-up calls. And that was the thing, if I'm honest, that was the thing that I really got out of the first book, that I'm not a total fruitcake. These guys who I think are the gods are human, and therefore it almost reassured me.
Yeah, and this was a surprise for me in the first book too, is that even some of these, like Marcus turned 30,000 into 80 million. And I know it's true because, I actually worked at Commodities Corp for a bit of time, so he was a legend, back then. Within the firm, nobody knew who he was. In fact, nobody. It was I don't know if anybody would have known he existed that I never the book, even though he was their star trader probably of all time. But even Mark, who I thought was so extraordinary, he blew up multiple times. Totally, it won't go into the stories, but he not only lost all his money at one time, but he even borrowed money from his mother and lost most of that. And he came from a low income background. So, I mean, it almost sounded like, why did he ever continue? I mean, it sounded like, I asked him that question in the interview. I said, didn't you ever think that maybe you just weren't cut out for this? And, maybe, after failure, after failure, after failure. And he just said, no, I just knew I just felt that I could do it. And so part of the lesson, one lesson is that early failure doesn't mean necessarily long-term failure. And the other lesson, I guess, is to be a market wizard, you have to have perseverance.
I think that comes out in everyone's story. You've got to be tough. There's no getting around it. You've got to have incredible depths of reserve of mental toughness.
Yeah, you have to have the right emotional state and capability, and that aspect of it, and something I know you kind of focus on a lot, but that aspect of it is critical. So people think about trading in terms of being a system or a method, that's involved, but but the psychological aspect of it is extraordinarily important. And like I didn't know when I wrote your initial Market Wizards book that a good part of what I was going to be writing about was psychology. I'm not trained in psychology or whatever, but the talking to these successful traders just naturally drove the conversation in that direction.
Yeah, and I think in particular when I was reading Amrit's story, and of course a lot of stuff we talk about, present moment awareness and the strength of that, of having positive mindset, but the concept of a deep now, I thought was just so well said. Through meditation, through breath, having an emotional calm, being very centered, focused, and avoiding negative mindset, where positive mindset was his core strategy, along with calmness. And boy, he came out with some stuff.
Yeah, I mean, he's one. There are a few traders in the book who really put a tremendous amount of stress on having the right mindset, and Amrit is certainly up there and maybe foremost on that. And the amount of preparation he does to be in the right emotional state, and keeping records, keeping notes, for years and years, hundreds if not thousands of pages of notes of the trades he's taken, and and being able to use that as an indication to his own mind, his own stability and emotional state. So so the deep now, which is a good phrase, does describe the way he tries to get himself when he's trading what he perceives to be a major opportunity. He wants to get in that state where it's not emotional. He's calm. He's prepared. It's very much like a professional athlete.
We hope you're enjoying this podcast. At this point in the interview with Jack left us for a few minutes just to go and check out the market close. So just a chance to quickly tell you about our podcast partner, the Society of Technical Analysts. The Society of Technical Analysts, the STA, are the world's oldest body for the advancement of technical analysis and price action, education, research, and knowledge. They provide outstanding services for their members, including top quality education programs. And as a not-for-profit body, they are not there to rip you off, just provide outstanding insights and learning. So please do check out the STA. Their website is sta-uk.org. Now let's go back to the podcast. Just to quickly give you a little bit of context. When Jack came back, myself, Mark, and Jack had a quick discussion. So what you hear now follows on from that discussion.
We had a great chat there about being in the zone and that deep now about Amrit. And I think, personally, I was really, really pleased that message was put out there, because even for professionals, that inner game nature of strength and it's becoming your edge there's a great lack of it, I think, in the professional world.
Well, it's interesting. The whole thing about emotions and trading, the perception of what trading looks like, or what the emotional state of trading looks like, is probably overly influenced by Hollywood. Where if you were to turn a camera on Amrit, it would be godly dull. It'd be focused and just sitting still, right? It wouldn't make very good film copy. But people have this image of yelling and screaming and emotions and fortunes being lost and made. It may make entertaining film, but it doesn't have anything to do with successful trading.
So if they make the film about Market Wizards, it's going to be a guy sitting there for hours.
There's never been one done, which I don't think you could do it.
But you know what, you made a good point there, and it was something I think that was in your interview with Peter Brandt, and you kind of had a different opinion on emotions in trading. I think you said that you think they're better being suppressed, or
I think no. I think that was aimed to John Netto. I think I know what you're referring to.
Or John Netto, okay.
John Netto, yes. So he's so his thing, he finds emotions useful in trading, and I say, well, like I've written every book I've written, I've tried to make the point that you try to get emotions out of trading, it's really detrimental. And I said, you want to get emotions out of trading? He said, why would you want to do that? And his point was that he uses emotion. He uses his own emotions, monitoring his own emotions as a signal. So if he said it's not good if he's overly fearful or overly think, oh boy, this trade is this, let's say he goes long and the trade's going in his way. He says, oh, this is going to the moon, I can't lose, and he wants to put on more. That being overly ebullient about a trade in an emotional sense, not in an intellectual or preparation sense or analytical, but in an emotional state, is a signal to him that it's probably going to correct the other way at that moment. So he monitors his own emotions as a signal that if he's getting too euphoric, that's a warning sign. So when he says, why would you want to get emotions out of trading? That would take away one of his indicators. But that's a difficult thing to do. I think for most people, you're just best off not having emotions at all, because I don't think very many traders would be capable of monitoring their own emotions for when it's going the other way. Although he does it, and it presumably can be used, but it's a tricky thing to pull off.
See, I tend to sort of agree with him that, most of the best traders I know actually embrace their emotionality. And that way they learn to live with it. They learn to recognize when they're going on a tilt state, which is the real downside or danger of emotion. And also they I think unconsciously recognize when they're going into flow states. And then a great trader, what they do is they can, to use the term, lump it on when they're in that flow state.
Yeah, So no, I don't disagree. And in fact, I kind of point out in chapter that while it seems we're kind of on opposite ends, there's no disagreement. I mean, the way Neto is using emotions, and as you've experienced with traders you've coached, makes sense. But generally speaking, emotions, for most people, emotions will lead them astray. I mean, we're talking about a very sophisticated type of trader where they've gotten to the point where they can sort of like almost out of body experience, sort of look at themselves and say, you're going too extreme, and recognize that. But for most people, emotions are, oh, this market's going to run away. I'm going to miss it. I better get in now. Or, I want to have a really big position. So, it's a bit risky, but I'm going to make a ton of money in this. I'm going to really increase my position. Or they're losing, they're at a point where they should get out. It's already exceeding their risk, but I'm going to get out right at the bottom. So I'm talking about all those emotions getting people.
Yeah.
But if someone's sophisticated enough to kind of recognize that in themselves, then
that's phenomenal, because when you talked about, and I think it was Jason Shapiro, recognizing the emotions in someone that's a representation of him, that was almost him reading what would have been. So he knows how he would have reacted had he been that guy.
Yeah.
And that's a way that I used to do that when I was a trader. I used to, you would just, I mean, that was the beauty of being in the trading room, which most of these guys don't have, which is, I suppose, unfortunate. But Jason's been clever in that he uses CNBC as that proxy.
Yeah.
When I was in a trading room, we'd see certain guys, that were struggling, and you knew that they didn't know they were being like this, but you knew that was a signal that the market was just going to carry on going that way, probably until they panicked out of it. And then that was probably a short-term low.
Yeah.
And a lot of traders I know have talked about doing that over the years in the office, reading the emotions of others around them, because they recognize that within themselves.
Yeah, that's what Jason essentially was saying.
Yeah. But, one of the points we were talking about when you disappeared, and one of the things we were talking about that was particularly relevant to this book, possibly more than others, was that everyone in this book eats what they kill.
Yeah, and that's the theme of the book. I was looking for solo traders who just, earning a living, or more than earning a living, in many cases, earning a fortune, but then, they're not managing other people's money. They're not getting any income anywhere. They're basically, and in some cases it gets pretty close, like the one systematic trader I have. Basically just, for over 20 years, been, earning a living office trading. And the hard point, and it comes across, and in fact, the title, I don't know if I use it as a title, but he certainly says, don't quit your day job. Because
Yes.
even though he's been successful, there was a point in time where he had a bad streak for like 2 years, drawdown. And it's, even though he had made money, but he was spending money for a living, he's paying taxes, and all of that. So people forget that money's coming out for taxes, money's coming out for living expenses. So it's not just that you're not far from your all-time high. You could still be in danger of getting knocked out of the game if you don't continue to produce profits, because then you've got expenses still piling on, and you've spent a good deal of your money paying off. Your profits have gone to pay off taxes and so forth. So it's a difficult thing to do.
Yeah, and I think there was someone in there as well. I think it was Pavel, who he literally does eat what he kills. He lives off what he earns as a trader.
Yeah.
And I thought, by the way, the chapter title, which you used for him, may be the best one you've used in any of your books. The bellhop who beat the pros.
Oh yeah. You mean the title wise? Yeah. I mean, his return, and even though he's trading a small amount of money, because this is a guy out in the Czech Republic who used to be a bellhop until he started trading after about a year. He quit his job. This is now, like, I don't know, 15 years ago, whatever, 13 years ago. But in any case, he's just every year he's eating his Pravia. His count didn't go up much because he's earning a living trading, basically. Yet he's trading very large cap stocks. So you could be trading a much larger account, but he's not managing anybody's money. And this is a guy who had very little money to start. So, he's still managing an account that's relatively small.
Yeah, and for him, I think it stood out that work ethic and appropriate risk management, and I guess appropriate size of trade too, was so necessary for his plan to work.
Yeah, certainly has the risk management side, and he developed a methodology that he didn't want to hold any positions overnight. So he developed a methodology that was day trading, but in a way where most day trading has a drawback of not these transaction costs eat up a lot of the potential profit. And by transaction costs, I mean mostly the bid-ask spread, not necessarily commissions. But he trades times where there's high volatility, so he can trade just for the day and be out of the position, because he doesn't want to take the risk of being in anything overnight.
No. And I think I guess I want to reflect back to Peter Brandt, because there was a nugget of wisdom in that discussion about get out on a Friday if your position's on a net loss. I mean, that is so important for people to hear that. So many people run that risk over the weekend, but there was a pattern he was following.
Yeah, so I mean, this is like, in each book there, some of the things overlap in advice, and some are basically kind of new types of lines. And this advice on Peter is that if he's in a position that has a net loss on a Friday, he gets out. You can always get back in, I mean, if at a later point. But the idea, if it's not working and you got a weekend, and because he considers the Friday price so critical, it's the most important price of the week, because that's the price, he says, that's the price where everybody's committing to stay over the weekend with that position. And so where that price is the most important price. So if he's behind on his position at that point, then he just doesn't feel it's worth carrying it over the weekend.
There's a point here which I wanted to just bring in, because that speaks to me of psychology again, of managing the mind, of making sure that you can, I always used to have, sleep trades. If you couldn't sleep, or I wasn't going to sleep well, I'd cut them out and revisit them the next day.
That's a sure sign that, I think a line I have in the book is, don't trade so large that fear dominates your trading. And if you're waking up worried about a position, that's your subconscious telling you you're too big. If you're waking up worried about a position, your size is too large.
And that's the theme again. These books are about psychology, and I opened the first book again, and I went to the first page of the preface, and I took a picture of what I read there, which I think sums up the whole series of books. And I'll read it out. It's what sets these traders apart. Most people think winning in the markets has something to do with finding the secret formula. The truth is that any common denominator among the traders I interviewed had more to do with attitude than approach.
Yeah, 3 decades later, I still agree with that, yeah.
And I think 3 decades from now, we'll still be agreeing with it. But the question I wanted to sort of lead into with that was, how should someone use the book? How should someone who's listening out there, who might be new, might be a few years into this, and they're starting to get it a little bit, how can reading this, what should they not just take away with it, but what should they do with it? What would you advise?
Yeah, so read it, and lines will hit you that apply to you. You'll recognize. In fact, what I've been doing lately is putting out a quote a day from the book, and I had maybe I can get it right here in a second instead of paraphrasing it. Let me just go to Twitter real quick, and because this person had a response here, which I thought is so right. It's so on point to what you're saying. So let's get it. This person wrote the following. He said, "Reading these quotes over the past few weeks, I have the same basic reaction to each of them. I am, 1, guilty at one point or another of violating the rules, and 2, they all seem to be confirmation of ideas I already know. Key theme, discipline wins the day." So I thought that was a great encapsulation, and exactly addresses your point.
Yeah, no, absolutely. What is it? I mean, do you recognize some changes? I mean, obviously, when you wrote that first book, we didn't have the internet, we didn't have mobile phones. As you say, apart from, there were some retail traders around, but most people were on trading floors, which we don't have anymore. And this year, just as a one-off, we're not even in dealing rooms. Well, they're trading rooms, aren't they? We used to call them dealing rooms. But what else have you noticed that's changed?
Well, the biggest change, of course, is computers and the entry to mass quant power in the markets. So back when I did the first market, the first Market Wizards book, you did have the PC, but for the talking to these traders about their career up to that point, much of it was pre-PC and in just the beginning of the early years of the personal computer, and sort of computing power. I think of somebody like Ed Seykota, and he was talking about how he was one of these early trend followers, but he talked about getting jobs where he could use the mainframe. We didn't have PCs yet. He would use an IBM 360. Now, he talked about that. Ironically, I knew about that because of my senior year in college, when I was kind of doing these punch cards on econometric models. You'd have to, that was an IBM 360. It filled the room, and it was like less power, way less powerful than an iPhone, or anything else like that. So these are kind of different days. Now we not only have that, not only have the PC, but we have supercomputers, and we have many firms out there that have literally scores, if not hundreds, of high-powered quants, mathematicians, physicists, astrophysicists, whatever, computer scientists, and so you have this massive power, both intellectual and the computers, the hardware itself. So that is definitely a big change. Many strategies that are run now by hedge funds couldn't be run. They were impossible to run back in the days of the first Market Wizards book. So that's, I think, the biggest change in the markets. And of course, we've had moving from bits to electronic trading is another really big change.
Yeah, yeah. No, and I mean, do you see? I mean, further changes ahead. We obviously got, AI is coming in, and that's going to be another change. And
So AI has been there, and I'm sure there's money being made on AI. There's also, I'm sure, money being lost on AI because, like anything else, it's a tool. And the markets, while they have certain qualities that don't change, because after all, it's people who are trading the markets, and there's a certain element of human motion that influences everything, that won't change, in a century or more, or 1,000 years for that matter. But so something like AI, yeah, it's a tool, but again, the markets are always changing, so the AI has to be adaptable as well, which it's supposed to be. But there are problems there too about overfitting and so forth. So you may get a point. It's the analogy here is to computers and chess. So there used to be a time where people thought it was impossible for a computer program to beat a chess master. Of course, we've now a number of years past the point where even the best chess player in the world cannot compete against a computer because it just can try out so many different combinations so quickly because of super computers processing. So the question becomes, will the markets ultimately get to that point? And I think it's hard. I won't say never, but it's a much more complex thing than chess. Now, sure, chess has like an extraordinary number of possible moves and all that, but still there are well-defined rules. In a sense, chess may be like planetary motions and figuring out the effect of all the planetary motions on each other. It may be a complex mathematical problem, but all the planets are following the same physical rules. Every chess game has the same rules. The thing with the markets is the rules don't change. The rules change. So you go through a period. There may be one period where money supply is a big deal, and there'll be another period where money supply is irrelevant. You'll have times where stocks and bonds move together. There's times where stocks and bonds move in opposite directions. So the markets are going through all these changes, and how it responds to different factors is always changing. And the factors that are important are always changing. And there's scores, if not hundreds of factors that might be affecting the market. So the complexity of the market problem far exceeds the complexity of chess.
There's a great point about that, because if you think about this complexity, and then you've got some guys who are still making millions doing very simple things that people were doing 30 odd years ago. And they're
like
featured
Brent.
in the...
Yeah. So yeah, it's there are certain elements in there there's certain elements about markets that are still there. They won't go away. Like, for example, trends. Trends will exist because if a central bank changes its policy, it's not going to flip back and change the policy 2 days later. So these things can last for years. The thing, of course, is in recent decades, the markets have, because so many people try trend following, the markets have enough whipsaws to make it very difficult to make money that way. But the general trends still exist. So as an example, if you recognize that and yet can trade with the understanding that you can get the markets whipping around and deal with that in a risk management sense, you can then extract money from a trend, but it's more difficult to do. And the same thing with charts. Charts, basically, the rationale for charts is the price chart reflects all the participants, it reflects all the market information. So that's the reason why there's information there. And there are patterns. Now, the patterns have a small edge. So even, like, for example, a casino in a game like blackjack or something doesn't have an enormous edge. It has a 1 or 2% edge. That's not really a lot. But the point is, they're taking that side so many times that you get a very good performance. It's not that they know that any particular bet is going to go their way. They were using probabilities. And the same thing is like chart analysis. There might just, if you're good at it, you have experience, you can pick points where the probabilities are over time you'll make money, but of course that has to be married to very strong risk management.
And that's the thing that comes through in the book all the time about the importance of risk management, and that's come through in every single book.
Yes.
And I guess this is one of the great takeaways for people who are new to trading, and if any of my clients are listening out there, they'll know how often I bang on about getting this risk management right. You could be the greatest forecaster in the world, but if your risk management is screwed up, you're not going to win. Simple as that.
Absolutely. I mean, risk management, as almost every trader I ever interviewed, successful trader I ever interviewed, would stress that risk management is more important than the method. It comes up repeatedly, whether they're fundamentalists or technicians or whatever. This is just a message that comes across all the time.
Critical stuff for those entering the market. Huh?
Right.
One other question, which really stood out in the book, and again, it's a point that you've made all along, and it's about this idea of matching your trading to your personality.
Yeah. So, again, it's a lot of these things are sort of counter to people's intuition of what's right and what's important. And I think people who are novices to trading come into it thinking, yeah, right, there's a way to trade the markets. I can figure that out, and it's going to be a money machine. And they think it's all about finding some special secret method, and totally miss the point that there's completely diametrically opposite methods that can work or not work. And it's not about finding a special type of method that has better than everything else. It's finding a method that works for you based upon what your inclinations are, what your beliefs are, what seems to resonate with you, what seems to work for you, what you're comfortable trading. So, and it's different for everybody else. It's like I've often used the analogy. It's like you wouldn't go buy a suit and ask somebody who is well dressed and saying, "Hey, what size suit do you wear?" Well, if they happen to be the exact same size as you, it might work, but the odds are they're not the exact same size. So what is the exact size for them is no reason that you expect it to work for you.
Fascinating, isn't it, really? And I think one of the things that also stood out to me is that if you're in this game, you got to love it.
Yes, and that's yeah. If you're going into markets because you want to make a lot of money, that's the wrong motivation. People who are really successful do it because it's a passion. It's something that in many cases they started even in their teenage years were interested in markets and began in some cases began trading as early as that. So the language they use is stuff like three-dimensional chess games or puzzles with 10,000 pieces where people are throwing in new pieces and taking out some old pieces. They're game-like analogies, and that's the attitude that works. And I mean, they talk about, like Camillo, talks about how much he loves that when he gets an idea, just kind of completely focusing and spending just all his time trying to work it out. That this is not something he's doing because he wants to make a lot of money. He's doing it because he loves doing it. It's a game.
Oh, it's fascinating. We've got so many sound bites that just come out of this book. It's almost ridiculous. One of the ones I like is if you're in a trade that's a hope trade, get out of it. But there's so many people that are willing on a trade and looking at a screen to sort of move the thing along. But crumbs, it means there's been no research. There's been no preparation for the trade, but it's very common.
Yeah, well, the very nature of it, that if it's hope that's a dominant feeling, that's a warning signal. So this, I think, came out of Hammer's chapter, I think, that particular quote. So earlier in his trading career, he took he took a position which was, even though he waits for the exact trade, and certainly now, but he took a marginal type of trade. He working for a prop shop. He took his maximum position, and to make matters and even worse, he then put full out limit positions on two other markets which are highly correlated. So he had a triple position on was essentially a marginal trade idea. And the risk manager came over to him and said, "Hammond, what are you doing?" And all of a sudden he realized that he was hoping, he put all his on hoping it would work. He got out of everything, instantaneously. And sort of made it for the rest of his, ever since then, made him conscious that if it's hope that's dominating a trade, that's a sign that it's not good.
Yeah. I got a question, which is, what I think you mentioned somewhere in the book that you feel that most successful traders you come across are discretionary traders. And yet the most successful trader of the past 30 years is Jim Simons, who's, as we know, systematic. Although I point out to people, he's on a different level. And he wasn't an overnight success either. It took about 12 years for him to get that model going.
There's a difference there, okay? So it turns out that, there are exceptions like Simons or Ed Thorpe, who I interviewed in hedge fund market wizards, who literally have the best return risk records, possible. So that's certainly true. But generally speaking, and in fact, in this book, everyone is a discretionary trader except for one exception. They may use some systematic approaches as tools or whatever, but ultimately, at the end of the day, they're discretionary traders. Because it's very hard to get a system that can be as good as a good discretion as a top level discretionary trader. Now, you're pointing out Simons and like Ed Thorpe, who I interviewed, David Shaw, who I interviewed in another book. The difference is those traders. Let's give the audience a feel of what they're doing. It's not the system in the traditional way we think of it. What they basically have, and Simons himself. Now, Simons is a brilliant mathematician, but he hired scores of other mathematicians. And what they're doing, and of course he's totally secretive and everything else. There is a really good book out there on Simons, the formula to beat the market. I forget the exact, but there is a book that came out in the past year, beautifully done book, because I couldn't get Simons to agree to do an interview ever. And the fact that he not only eventually got him, but he got all these people to talk, I thought was and he did a very good, excellent narrative job. So
the book Jack is talking about here is The Man Who Solved the Market: How Jim Simons Launched the Quant Revolution by Gregory Zuckerman. You can hear Greg Zuckerman talk about Jim Simons in our podcast episode from the 14th of January, 2020.
My hat's off to that book. But bottom line, these approaches, what they're doing is you have all these brilliant mathematicians looking for, they're not trying to get patterns, that are one pattern's going to make you all the money. They're probably doing hundreds of different types of things. And not only that, in many cases, the strategy might include trading thousands of different securities outright, options, futures, FX, and relationships between them. And they're looking to extract little bits of money just from all of these patterns. So it's extraordinarily complex. It's not something that is doable by a single person. There are still inefficiencies in the market. They change and they're hard to find. But if you have enough brain power and you put enough of these together, then you can come up with something like that. So, but it's not something any single trader can duplicate.
Yeah. No, that's. I think that's apparent. I did try and build my own system many years ago, but it didn't suit my personality, which really comes back to that point about personality. I was never going to be able to live with the drawdowns that this system was suggesting was going to be part of it.
I actually, for a time, went that direction because I thought it was a way to get rid of emotions. And to the extent it is, but what I found was that then you're kind of if you're purely staying with a system, absolutely, then you're at the mercy of what the drawdown is going to be. You lose some of that risk control. So, and I was very uncomfortable. I was uncomfortable with that. So, ironically, while I went to it because I thought it was a way of eliminating emotion, I found for myself that it was actually could just have the opposite effect. It could make it more emotional. So I ultimately decided that having being discretionary and being able to define what risk I was willing to allow for a trade at the outset was a more comfortable fit. Again, it's what fits your personality.
Yeah, it looks as though the principles of the first book are still very clear in the current book, and not a great deal has changed. I mean, from my view, I know some of the technology's changed, but at a core level of traders, the vulnerabilities are still there. The absence of appropriate process still, or the importance of appropriate process still stands out. The importance of risk management still says that, and we're now starting to realise the importance of self, development of self in the complexities of markets is as vital, perhaps more vital now than it's ever been. Perhaps we're realizing now that it's vital, and perhaps have not realized that the softer skills were actually part of building our edge. Would you agree with that, Jack? That it's starting to feel that way, that we're starting to realize these things?
The general comment of not much has changed is, as we talked about before, is because there are certain traits that are conducive to being successful in markets, and traits that are conducive to failing, and those traits, that has not changed over time, regardless of how much else has changed. So it would be natural to expect overlap in the principles one might draw from the Market Wizard's book, written 32 years ago versus, one written now.
Yeah, it's a massive lesson for people entering the market that these core principles are vital to learn at the beginning of the journey, and just realize what they are for their own personality, and applying these rules. So again, we can't, I think, emphasize that enough.
What three things do you think a trader should really look to learn from unknown market wizards?
Well, the top three, you always have to put risk management first, because without risk management, success is not possible, right? So it's, success is possible, but ultimately it'll be a crash and burn in all likelihood. So I would say if there's anything that's absolute to successful trading, is you have to have an effective risk management approach. Second would be that I think ultimately was talked about before, is you have to develop a methodology. It has to have an edge, and these are a couple of things really all wrapped up into one. And that approach has to fit your personality. So it's not a shoot from the hip approach. It has to be something that's well defined. It has to be something that has demonstrated through your equity going the right direction is effective, and it has to be something that you're comfortable with. So that is another critical one, and ultimately, almost everyone, if not everyone, I've ever interviewed that's successful has strong discipline, and you just need iron core discipline. Sort of like a trader in his book is an ex-Marine, is the ex-Marine that I've had in a Market Wizards book. So the Marines the image of a Marine does go with discipline, and it's no accident.
It's fascinating though that some of them didn't have discipline, but they got there eventually.
Yeah, so like we talked about Shapiro, right? He didn't have discipline. And what happened? He wiped out 2 times.
Yeah.
So it wasn't until he got, and he says in the book, and he said, "I will never, ever, ever, ever go against my stop." Absolute no way you could put a gun to his head. He decides where he's going to be out of a trade. If it's at that point, he's out. There's no question. Doesn't make a difference. Nothing else matters. So he had to go from this lack of discipline, this fighting the market, to the exact opposite to be successful.
Yeah, that's one of those stories which I think you capture so well, this kind of the human nature of trading, the human part of it. I mentioned it earlier, that the fallibility that we have as individuals, and how we somehow think, I don't know, it's like we almost forget ourselves. I remember when I was, when I first read your books, and I think I used to read all of them every 2 or 3 years. And I used to come across a point where I think, I must make a note of that. And then I realized on the next page that I'd actually made a note, and I was doing the same thing. And it was like I'd forgotten.
That's exactly, you asked before about what people can get out of it. One of the main things is, by reading this book, you can, and like the quote I read you from somebody else who replied to a tweet, you can recognize mistakes that you yourself make. And by noting them and being more aware of them, well, you'll probably still make those mistakes in the future, but at least you'll make them less often. And the best the best method to become a better trader is to ideally eliminate, but at least reduce repeating the same mistakes, and learning from your mistakes.
Yeah.
And this learning from mistakes is something that comes up in this book quite a few times, and it's something that's come up in other books. Ray Dalio, in particular, I think it's almost worships at the altar of learning from mistakes.
Yeah, his principles. Can I ask you a question? And it may seem slightly controversial to some. And I know you tried to find some female traders to be in this book, because you asked me, and I did send a couple, but I think they were from institutions, and you wanted to do
one of them. And so I always would like to get more women in the book. In this book there are none, and I did interview because. But again, the problem there was, the person was a good recommendation, and she had in some sense, a fascinating story. I love her grit and everything else, and I would have loved to include it for that. But ultimately, when I had the book, I did do the interview, but essentially, this was a book of solo traders, and sort of a head manager just didn't fit thematically. Moreover, in this particular case, her approach is pretty eclectic. Now, I could deal with that, and if that was the only impediment, I would have dealt with it. But the combination of not fitting the theme of the book and having a very eclectic approach, which most traders would not at all relate to, just said, well, it's just not a fit for this book. But yeah, so as you've noted, I certainly would like to include more.
The people here were self-employed and self-starters. They weren't. There was nothing that said, no reason why it couldn't have been a woman. But there just seems to be very few women retail traders.
Even hedge fund managers. Now there's much. There's more certainly than it used to be. But part of this is, remember, I'm looking for typically traders with 10 plus years. And in some cases, in this book, 20 or 30 years of experience or track record. And so, if you go back, women who've had long, it's not easy to find women with long-term track records that are spectacular, because there aren't that many women with long-term track records to begin with. So, maybe 10 years from now it'll be different. But even now, it's difficult. And when I did my tweets asking people for I'm doing a new Market Wizards book, and I'm like, maybe that's the way. Maybe you responded to that particular. Maybe that's how I. Maybe it's how, I forget if that's how we connected or not.
I know my daughter's always asking me, Dad, why are you not having more female traders on the podcast? And we did reach out to Linda, and I was gonna reach out to her again at some point soon, because she's a phenomenal trader. I think she was in your first or second. Yeah. So there are some out there, but I wonder if it's just a profession that women aren't attracted to that much.
It probably is changing now, but certainly historically has been true. It's been I can't think of not many professions you can think of that are more male dominated than trading.
Yeah, it's strange, but as you say, maybe that'll be a future book.
I'd be very happy to do women market wizards.
Well, listen, maybe you'll get a few
Yeah, sure.
reactions to
I'm
this.
always I'm very open minded, and ironically, I kind of believe that women are probably better suited to be good traders than men, because I think a lot of male dominated instinctive traits are counterproductive, like aggression. Men are more aggressive. I don't think that's necessarily good for trading. Um, Men tend to be probably more stubborn. Something like
Yes.
less flexible. Uh, Although the really good ones who I interview are flexible, but women I think have certain traits that are more amenable to being good traders. But I just think it's a matter of way things have evolved, and it will probably change. So
Yeah, no, I mean, I see some on FinTwit who are out there who do seem to be very good. And maybe I don't know, maybe they're just hiding away and don't want to put themselves out there. It's quite a scary thing putting themselves out for an interview. I know I spoke to a few other traders who are phenomenal, and they were really, you know, they didn't want to say their names, for example. They wanted to do it, but didn't want to say their name. And I know you insist on always having the name and the
it
backstory.
would have been possible. It's more important. I just have to verify the track record. So if somebody was only willing to do it anonymously, I would have probably been open to that, because after all, this whole book is filled with people who nobody knows anyway. So the name is almost, and in fact, in Shapiro's chapter, because he made many kind of very tough comments about people, he asked me to use pseudonyms. So that whole chapter is filled with pseudonyms. So I'm not so tied to having an absolute name. If I could verify the track record and somebody wanted to be anonymous, that probably, if it was a good enough story and a good enough track record, that probably wouldn't be a deal breaker.
Markets can stay irrational longer than you can stay solvent. Yeah, but it was within Jason's piece, I think, wasn't it?
Yes.
But yeah, it's a beast. It's difficult. I mean, I always compare markets to like the murmuration of starlings. It's got depth, it's got beauty, it goes out of shape, it comes back into shape. And if you're in the game, you've got to be pretty tuned up to what's going on, because you're on that ride. And I think, as you've started to conclude from some of these stories, you've got to love being in that game, because so much can go wrong super, super quickly. And you've got to have the intellect to, get out rapidly when you can. And I think that comes through beautifully in these stories. And I've said it several times, but there are so many lessons in this. There are almost too many lessons for us to even, do this within a 24-hour period, this sort of podcast. Your 40 tips or 45 tips or whatever at the end of the book is a book in itself, in terms of a short guide to what you need to know if you're going to be coming to this market. So I think we appreciate the effort. You've curated these stories that are so important for us to even go back in time and compare, and think, actually, there's a lot of stuff that's just not changed here. And are people, despite the technology, making more money? Well, actually, they're still making the same mistakes. And there's some big lessons that we should learn. So we got to thank you for that.
Well, thank you very much.
Thank you, Jack, and good luck when the book comes out next week. I know so many people have ordered it already, so it's.
And how can people find you, Jack, if they want to follow you on Twitter and on your website?
Well, Twitter, so on Twitter, it's at Jack Schwager, just my name. And if it's a website, it's jackschwager.com. So everything's my name, kind of, and funseater.com. In terms.
Fantastic. And of course, the book is The Unknown Market Wizards by Jack Schwager, and we encourage everyone to go out and get a copy.
Well, thank you.
Thank you for listening today, and thank you to our podcast partner, the Society of Technical Analysts, the STA. Again, you can find out more about their excellent services, education programs and courses by visiting sta-uk.org. If you have enjoyed this podcast, please feel free to rate us and review us on iTunes, Spotify, or whichever service you've used. More ratings and reviews helps other people find out about the AlphaMind podcast. You can also connect with us or follow us on social media. At AlphaMind101 is one of our Twitter handles, and at AlphaMind102 is the other one. You can also view our blog page, alphamindblog.blogspot.com, where we have lots of articles, information about the podcasts, and pages of books and other podcasts which we highly recommend. Finally, if you want to know more about us and our services, please go onto our webpage, alpha-mind.net, or go to our individual pages, alpharcube.com and markrandallconsultancy.com. That just leaves us to say have a great week, and we look forward to you joining us for future podcasts. Thank you very much.